It's my absolute pleasure to be with this distinguished panel today, and I would perhaps ask the panelists to introduce themselves. Maybe let's start with you, John.
Thank you, Ruta. So my name is John Ditchfield. So as the slide says, I'm a wealth management advisor, and I headed the development of the responsible investment offering at Helm Godfrey, and I also have a research business called Impact Lens. So what I've done, I suppose, is I spent my entire financial services career working in what was, and I rather liked it that way, I'll be honest, a tiny niche. No one was really interested in responsible investment in the late 90s, early 2000s. But lo and behold, it's a big news, isn't it, really? And ESG is obviously a big part of that, but there are all sorts of other topics we get into. Sorry, I've already said too much. There you go, Vladimir.
I am Vladimir Demine. I'm the head of ESG research for one of the teams at Morgan Stanley Investment Management, the international equity team. So we are one of the larger boutiques within MSIM. We run about $50 billion. Most of the money is in highly concentrated global long-only equity strategies with long-term holding periods.
Hi, Cara Williams. I'm with Mercer. I'm global head of ESG and sustainability for the firm, and we are, I guess, world's largest investment consultant with about 16 trillion under advisement and about 500 billion in OCIO. We have had a responsible investment team, Sustainable Investment Now. They've been renamed for about 18 and a half years and have rated close to 8,000 strategies on their ESG.
Fantastic. So I think I would start with you, Cara, and just ask whether you think we got it right. Is ESG a critical component of investment decision-making? And if so, how could companies develop ESG-focused strategies, perhaps also delving a little bit into the nuances between ESG versus impact investment?
Yeah, so I mean, I guess to John's point, it feels like there's this like sudden emergence of ESG, which there really shouldn't be, right? ESG is effectively just taking into consideration relevant factors when you're choosing to invest or not invest. So when Vladimir's team is choosing what stock they're going to buy, they're looking to see whether or not that company's run well, right? So that's ESG basically. Is it good for people, planet, community, and ultimately that means it's going to probably perform pretty well. And I think what's happened recently has been that there has been a lot of great marketing and miscommunication, and investors have started to think that ESG means I'm doing good with my money, and that's not what it is. That's impact investment, and that's not what our panel today is about. An impact investment is very focused. You decide exactly where you want to make a difference, and you choose how you're going to allocate to that specialist area. As I said, ESG, my view, is very different.
Vladimir, I noticed you were silently nodding the head. Would you agree?
Yeah, no, I completely agree with that. And in terms of how you create strategies that address client demands, I mean, obviously, you have to, well, as we say, ESG means different things to different people. So we highlight, well, sustainability investing means different things to different people. Therefore, you have to be very clear about what your clients want in terms of knowing your client base. Some people want exclusions, some people don't want exclusions, some people want more impact, some people happy not to have it, etc., etc. So it's a very heterogeneous market, and we are lucky in the sense that our team has been running money for 30 plus years, so we have a very sort of very sticky client base in many cases, and therefore we understand what they want, and then obviously that drives what we how we structure our approach. But this is mostly obviously institutional and intermediary clients rather than retail. Retail is much more difficult to track.
And that's where I come in, retail, isn't it? But maybe.
Anything to add from the retail perspective?
Well, yeah, I mean, as the other members of the panel have already said quite correctly, ESG is almost an industry construct, isn't it, really? Very few private individuals would really understand ESG. I think in the wealth management market, not many advisors are prepared to really understand what's meant by ESG investing. It's an industry solution. So, yeah.
And maybe staying with that thought, I mean, with your experience within the space for so many years, to what extent can technological innovation define the successful integration of ESG strategies, especially thinking about wealth management as well? Do you have a silver bullet for it? Do you think it emerged so far, or are we still long way?
Not at all. In fact, I did a project with a chap who was on the last panel, Ramin from UCL, just on that. We spent, not a huge amount of time, but we looked at the question of, could we build some sort of service that would allow advisors and investors to rapidly identify, into which, how would you say, area a particular fund was falling. Is it an ESG fund? Is it an impact fund? Is it a sustainability fund? And it's incredibly difficult to do because of the extremely heterogeneous nature of the market. All of the funds use different descriptors. They do things very differently. I'm talking here about retail, OICs and investment trusts. So, yeah, the market is a bit of a mess, really. Oddly enough, that was the role of Impact Lens. Impact Lens's remit was essentially to research the market, looking at retail investment funds, consider what those funds are doing, and then try and classify them for model portfolios or solutions offered by private client advisors to retail investors. So we tried to build something there, but this idea that you're going to create a sort of supercomputer that's just going to point to the right fund for a particular client, I mean, that's some way off. And unless you're about to tell me it's here, these guys are, these are the real brains here. Maybe it's already here and it's been invented.
No, I wish it was. I'd say to me, the main issues is if you even go back to the heart of it is really there are no established frameworks for corporates to be able to report out. So the environmental is getting better, right? You've got TCFD, SASB, and a couple of other requirements, so that's helpful. But now, there's talk of TNFD and God knows what's next. On the social side, it's really hard. If you're a corporate trying to run a company well and you want to actually do good and do right by humanity, it's very difficult to actually report out in any kind of regulated fashion on your S piece. Governance is also difficult. You can prove good governance by kind of showing a bunch of frameworks and things that you have internally, but again, it's not particularly measurable or quantifiable. So again, when people like Vladimir are trying to assess companies, it's very difficult because it's not like for like, corporate to corporate, because the corporates don't have a standardized framework. So then you get down the food chain to what John's trying to do and work with clients and explain it to retail investors. I mean, I think it really starts from the fact that the corporates need regulation.
Absolutely, and I think when we talked about this topic. We kind of agree that it's probably not possible to talk about it without talking about greenwashing and employing the right practices in order to avoid it. I maybe will ask Vladimir to share, how do you approach, to say, greenwashing due diligence? What are a few examples you can share, or perhaps practices that you think are extremely important in that field?
Okay, well, I'll talk about trying to detect greenwashing in companies that we invest or want to invest, and Cara can talk about trying to detect greenwashing among fund managers. But in terms of the research in the corporates, again, I think technology is helpful, but it's not the complete answer. You always need a human to do the sort of fundamental analysis, and they have to understand what they're looking for. And again, because we run very concentrated pools of money in most of our strategies. We have the bandwidth to go and basically engage with every company on a regular basis, and we have the mental shelf space to analyze, where greenwashing may lie in their disclosure. So a good example would be, we're talking to all companies or investments on carbon reduction targets, and some companies say, "Oh, great, we've reduced our emissions by 30%, and it's we are 100% renewable electricity," or something like that. And then you have to understand what it actually means. And in many cases, it means that the company just went and bought a lot of renewable energy certificates on the market, which is just kind of an accounting tool. They're cheap, they're easy to buy. You haven't actually made any real world difference or improvement, but you can report that you don't have any scope to emissions from purchased electricity. So, and there are different tools like power purchasing agreements where companies that use that actually make that difference. They actually kind of fund the incremental renewable capacity. So you have to kind of peel the onion and look at and ask the questions, and it may be several times before you get several iterations before you get to the answer. So in summary, it's like it depends not just on the data. All the data is very useful, but it's the kind of the human behind it who has the time and the resources to engage with companies or do the desktop research.
I think that point about more and more data providers entering the space, not necessarily knowing the ESG area, but being very good from the technology perspective, kind of poses the interesting question whether it is possible that technology would do everything and we wouldn't almost need the expertise. I understand that you think that's way ahead or almost impossible. I'm wondering whether, John, from your work in this area, you think, is it possible? I mean, can, so to say, technology solve it all, or is it really hard?
Well, I mean, it's sort of theoretically impossible, isn't it? But I'm simply saying that in reality, investment funds are very complex products. There's a degree of, what I'm seeing in the market is funds are clustering around particular types of solutions, particular ways of communicating. So thinking about the UK investment fund market, you're starting to see some, similarities developing, but there isn't really a regulatory framework that prescribes how funds are to talk about what does sustainability mean, or what does impact investing mean, or how do they integrate their ESG data into their process. So it makes it very difficult to build something that's going to automate selection. And then you've got the problem of people being the ultimate heterogeneous group, in that they all have very different opinions about what is a sustainable investment fund. So, I work for private clients and charities, and many of those charities will have very particular views about how they want their capital to be invested. And it's extremely difficult for the fund management industry or technology to engineer a solution that's going to, it can be useful, but it's not capable at the moment, and I can't see this is going to happen very soon, able to deliver an automated solution for this.
I would agree, and also, I mean, for entertainment's sake, sometimes it's fun to look at Sustainalytics and MSCI and look at, you get completely different results, and it just shows that there really isn't, thus far, a silver bullet provider that can really assess these things easily for everybody just to sort of quickly take a look. And I think, as was at the intro was mentioned, you also have different countries, different approaches, and the idea that ESG is potentially a sacrifice to returns, and particularly in the United States, obviously that seems to be the view, but that's been politicized, right? Whereas again here, it should just be posed as a way to make better investment decisions, really. But.
Yeah, it's really difficult, and I guess vendors also approach different questions within the area of ESG. So they try to bring more data to their attention, and also the biggest or better breadth of the data. But I guess some of them also look into the ability of accurately measure ESG impact. And I was wondering, where do you think we stand with that? Where are we in the journey of accurately measuring ESG impact, probably to both the fund managers, but also the impact investing?
I mean, there are obviously tons of startups in this space, and it's like you said, they all have really interesting, probably pretty smart approaches, but they're all so disparate. It makes it quite difficult to how do you put it all together? I mean, already wealth management's got so many different sort of wealth tech providers, but in this space it's even worse. I think I'd mentioned on our prep call that we met with a startup that has figured out a way to allow smaller asset managers to create a consortium so that they can actually start to engage with asset managers or with corporates and start to measure their impact on the governance side, right? So an interesting thing to do, but what do I do with that? Like, what do I want to subscribe to that? I mean, it's just a strange, so there are all these very sort of odd, small startups that I'm sure they're all hoping to get bought up, but I'm just not sure who's going to be buying them up. I think in this industry, really what's really needed is, data curators and data scientists, right? That's who's needed. There's plenty of data, there's plenty of information. But like I said, in the social side, it's a bit of a mess. But even there's probably data that a smart curator could figure out what to do with. So, I mean, if anyone's got kids, that's where I'm pushing mine to go. So.
Yeah, that's definitely a good career for the future. Would you agree, John? Or?
Yeah, I'm forever telling my 17-year-old he needs to get on FE Analytics, our research service, and start analysing impact funds. And I ran a sustainability competition in a local school where I got, we were between the ages of 15 and 17 to write essays about this topic. I'm taking this invitation very seriously. So, I think there's huge opportunity, as has been said. There's lots of information there. There's certainly a great deal of intellectual firepower being applied in this area. So I think there's a great deal of cause for optimism here. Certainly in the period in which I've been advising private clients on this, you've seen a huge improvement on the fund side in terms of understanding of these issues. I used to go to meet fund managers and there was almost disbelief that we even wanted to talk about environmental issues or social impacts. I'm sure that wasn't the case for my colleagues on the panel. I'm sure they were very interested in these areas already, but so there has been significant shift and things are getting better. I think the thing we're sort of pushing back against is this idea that you're going to design some sort of computer that will just deliver a result to a particular client and meet what they want, and that's just going to get it right every time, and that it's going to meet the kind of suitability tests that the regulator requires, Which is interesting, given that, we were chatting in the break room just before we came in, that obviously the FCA has now proposed a set of labels, so we will, sometime, I think it was in 2024, have labels for fund products, so perhaps that is the solution we're all waiting for. I'm, saying that rather skeptically, but, it moves the market on again, doesn't it?
Absolutely. And Vladimir, you probably talk to a lot of these providers as well. So could you share some thoughts about, the movements in the space?
Yeah, I mean, we get emails, from ESG data startups almost every day. And it's like, then obviously the task is to sort the ones that are relevant and not relevant. There's a lot of things like, sentiment tracking, which is very popular, where, these providers go and check for what's happening in the online, basically what people say, what the newspapers say about these companies. So that may be useful for some investors, but not really for us. In terms of, we are very interested in impact measurement, and we are talking to some people. We've seen some people with interesting methodologies using AI sort of to measure companies' or portfolios' contributions to the UN Sustainable Development Goals, but these are very few of them, so you have to kind of sort the wheat from the chaff. And it's more about the underlying methodology rather than the actual tech. I mean, AI is helpful, but in a lot of cases you see great AI, or what they say, AI tools and great interfaces, but the actual methodology and the data behind may not always be relevant.
So a little bit of a, so to say, development still needs to happen in order to meet your demands with something that the companies have to offer, and probably then implementation is also very important, right? How do we integrate that into the decision making and integrate that into the process flow?
Yeah, and on that, I mean, some of it is pretty sort of basic. It's there's so much data around. The question is not just the quality of the data itself, but how is it delivered? Is it easy to integrate into your investment research notes, et cetera, et cetera? Is it intuitive for everyone in your team or in the firm? Intuitive in terms of understanding what the data means, and how do you actually use it? So that's sort of some basic stuff that it's getting better, and both from the provider's side of view and like what the investment managers are doing in-house themselves as well.
I will ask something slightly, so to say, off topic, but I think it's quite an important one. But when it comes to the, buy versus build, and especially, you know, developing some of these capabilities in-house versus talking to the partners, talking to the vendors. Do you have any specific approach when it comes to the ESG? Do you think there are some almost, you know, the most successful strategies in this space?
I mean, we tend to be proponents of buy. In this space, just given the longevity, I guess, of the group that's been focused on this, we have created an ESG assessment tool on assets. So we automatically run it on all of our portfolios with our clients to assess how the portfolios look across E, S, and G. And then basically benchmark so that clients can see how they look versus other asset owners. Soon to be rolled out for asset managers, so I'll give you a call, Vladimir. But yeah, so for us, it's an unusual one, but it's really just, I think, by virtue of the fact that the market doesn't really have something we need, right? So we just sort of said, all right, I guess we have to build it, which is unusual for us.
I guess it's the same approach for us. I mean, if it has to be highly customized and bespoke, you go for the pain of building it in-house. If it's something sort of discrete in terms of like just one cool sort of data set or, you know, provider or tool, then yeah, we would buy it. But then depends, yeah, how many tools do you want to buy at the end of the day?
Absolutely. John, do you share the view?
Sorry, I mean, what we will do at Impact Lens is we will go to a particular fund group and we will try and understand how they're using ESG data as part of their stock selection process. I don't think what we're seeing is that generally asset managers are skeptical of any one ESG provider and will tend to overlay that with, you know, the top end. They will tend to overlay that with their own judgments about the ESG data they're receiving. What we're seeing is this sort of emergence of a two-tier approach there, that they receive in information and then they consider whether they, you know, support the ESG score that's being given. So again, you know, it's an example of where fund groups in the space where I work in retail investment advice are, you know, certainly looking to operate much stronger processes and are employing a lot more people to consider these types of issues. So, you know, it's a positive development, I would say.
Excellent. And then looking into the future, you know, we have COP27 around the corner. I think ESG is a topic that is being addressed more and more. But if we look at the new skills that are required in order to move this forward, and then the new technologies, where do we stand there? What is almost required for the upcoming 5 years? You mentioned already the FCA consultation, right? What do you think we really need in order to accelerate in utilizing data and getting more impact from the ESG strategies?
Shall I have a go?
Luckily, we all have somebody that says, you go.
Yeah. So in my market, what you've seen is advisors are really keen to improve their skills in this area. I don't know if it's in the FCA paper, but certainly, you know, there's clear evidence that advisors are looking at this area much more seriously. You know, certainly within the term of my career, you've seen this enormous growth in training that's available through the CFA's paper on this. You know, so there's been a big shift in terms of preparing wealth managers to have these types of conversations with their end clients. So that's, you know, that's been happening. Then you've got these questions of the kind of operationalization of COP and the Paris Agreement and the TCFD framework and what the FCA will be doing in 2024. So it's all symptomatic of you know, a recognition that the investment industry has to consider sustainability as an important factor, I suppose. So.
I mean, for me, I guess it's the emergence of things like WEF and COP. Like COP last year was probably the first time we started to see a lot of sort of private industry. appearing. This year is heavily sort of representative. So lots of asset managers are going to be there this time around. Lots of insurers are going to be around. So it's not just governmental, and I think that's a really great sign, because what you really need is you need governments and industry working hand in hand to try to sort this out. And while obviously there are going to be loads of skeptics about the value of things like the WEF and COP, for me, they are highly valuable. It's the cooperation, industry cooperation, and companies that typically compete with each other, working together towards a common good and a common, again, framework, so that they can actually do right by their investors, I think is a great shift.
Vladimir?
Yeah, and I think from the investment manager's point of view, I think the greatest sort of need, and hence you need to develop the skills and acquire new technologies, is to kind of better understand your portfolios, your company's impact, what is an externalities type of impact, positive and negative, because that's where we get sort of increasingly more questions. Obviously, regulation plays a part where, within, for example, SFDR, you have to, it's effectively the numbers or the data you report to the world, to your clients and the regulator is mostly about externalities, and at the moment the data is quite crude and missing, etc. So I think it would be ideal for us to have a technology tool that, and I'm echoing Cara's comments, I think at the beginning of the session, where all this disparate data is aggregated and presented, standardized and presented in a way that helps us understand what the positive and negative impact of our companies is. So that helps us to be more transparent with the clients, with consultants, with regulators, helps us understand where we need to engage with those companies. At the moment, yes, it's all a bit all over the place. Yeah, I guess the skill is like, how do you, is looking through different solutions, data-driven solutions, to try to get to that stage. Yeah.
And if the data question is solved, do you think there is a gap in the skill set of the people or employees or the specific, so to say, professions? Or you would say that let's, so to say, sort out the data or technology issue first, because actually, we do have people who are well-versed in actually working with the ESG principles and understanding the topic and carrying the conversations. John, I wonder what's your view?
Well, it's not an area that advisors have traditionally covered themselves in glory, and I would tend to say. I could speculate as to why that is. I don't think I'm going to do that. But, wealth management is a particular type of industry. It attracts in people who in the main aren't dark green environmentalists or necessarily sensitive to questions around environmental, social issues, certainly around governance, that's accepted and, would be accepted that they have to pay attention there, but around other issues less so. And I think as a result, my industry has been slow to adapt to what's happening in the wider society around the environment and around sustainability and the kind of things that have been mentioned, really. But what I'm seeing is that the providers are stepping up. Aviva's been running a lot of courses for advisors. You've got the CFA's courses. I think the CII now has a course on this area. You used to be able to sit the CISI's investment paper and the CII's investment papers, and there wasn't a single thing in there about sustainability or about ESG. It just wasn't even mentioned. It was just classical economics and that was it, really. So, there's been a huge shift just in the last 5 or 6 years, I would say.
Cara, would you agree with when it comes to the people?
Yeah, so I think if you look at sort of traditional portfolio managers that, let's say the firm has decided that ESG is going to be something that they incorporate because it's part of their marketing spiel, you do see and hear a lot of frustration in trying to get those senior portfolio managers to actually genuinely accept and adopt ESG into their processes. So there's no question we do have kind of a breed of dinosaur portfolio managers that still do exist, and maybe their firms are insisting on this, but they haven't really bought in. And it's the same on DEI and having good diversity on their investment teams. And they kind of nod, but they don't really do it, and they certainly don't believe in it. So I think there's no question that we still do have a massive generation that is a bottleneck. But there are lots of young people coming up, and John and I luckily have teenagers, and so we will be populating the industry, hopefully. Well, hopefully at least they're gainfully employed.
I will
That's all
join
I care.
Steady on.
Yeah, but I think there is right now there is an absolute shortage. But we do see that there's a lot of people coming into the industry that have very different backgrounds than traditional.
Yeah. I would say that, sorry to jump in there, but I think diversity has been a massive problem, isn't it, in the industry? So you do get a lot of groupthink, and you do get, a reluctance to accept what might be termed as new ideas and new thinking. Let's hope that changes, Sorry.
Well, in defense of asset managers, portfolio managers, I could say, yeah, I mean, there's obviously an element of this in terms of how fund managers were trained when they started as juniors, and what they are used to care about and not used to care about. But there's also, even if you get this sort of the emotional buy-in into ESG, right? We want to do it. Like, we think it's important. It's commercially important. It's important for the planet and the society and everything. Then it's like then you bump into these questions we've discussed, like I know what a PE is, I know what, how to read a balance sheet, all this data is at my fingertips. On Bloomberg, it's all standardized. I can compare 20 different companies using sort of commonly accepted sort of investment metrics and approaches. And so how do I do the ESG? I understand carbon emissions are important, but like, how do I integrate it? So that's, but I think the industry has gone a long way in terms of, and I can obviously look at our business, it's gone a massive, it's made a massive journey into better understanding, day after day, building awareness, knowledge, the muscle memory practice of, what you think about, what you look at when you obviously try to marry, ESG and your sort of financials or investment strategy, purely financial side of it.
Absolutely, and especially when it becomes or is a critical component for that decision making. It's just about probably bringing the right people and then teaching the people or giving them the opportunity, right? I mean, to discover the topic themselves. I will just ask whether we have any questions in the room, perhaps. I can see a few hands, perhaps the lady here first.
Thank you. Hi, this is Parul from Arabesque. So first of all, really good to hear that the panel thinks that ESG is really nothing different but a factor to be seen when investing, in general. Probably I'll start with maybe Cara, if you can expand a bit more in your role, how much of the remit of your role is about actually going to all the managers that Mercer, kind of puts on the platform to kind of not just ESG labeled funds, but every fund should be seen through that screening, and how successful you are being in that, group wide.
So we've always done that, for the last 18 years. So when we rate strategies, it's the ratings from 1 to 4, and it's always done qualitatively. So there's an investment rating, which is a letter rating, but then there's an ESG rating, which is 1 to 4. I'd say typically ESG marketed strategies very often do get 1s, right? Because that's the best. That means that is the end all be all. That's what these people think about all day long. But for us, a really solid, sort of a 2 or 3 is actually good, because that means I think Vladimir, the way he even just described a company as, if you're investing into a fuel, or a energy firm, really understanding and being able to articulate why you've chosen maybe BP over Shell, and it's because you think that maybe their journey towards renewables and their transition is actually something they might actually achieve. For us, that's, you're taking ESG into consideration. You're not saying we're not going to invest in any energy providers. It's a very different thing. We're not talking about divestment. So yes, that's why we've got close to 8,000 strategies qualitatively assessed. And it's any strategy that we use, and any strategy we use in OCIO has to have been ESG assessed as well and have a certain rating.
There is a question over there. If we could get the mic. Thank you.
Hi, I'm Grayson Greer from First Rate. And with over 125 plus different ESG providers out there that have various scorings depending on whether they're doing consensus scoring and their own different types of methodologies, how do you go about selecting the correct or the appropriate ESG data provider as you think about your clients?
Yes, I mean, from vendor selecting point of view. Vladimir, I think that you did some of those.
Yeah,
right?
that's a tough job. I don't think we've looked at all 125, but I mean we use several providers. You have the usual suspects, which we use not because we sort of necessarily trust the ratings or the final score itself, but there is some interesting or useful underlying sort of raw data, which is the easiest way to get it. But also you obviously want to know what the biggest provider thinks about your companies, whether you agree or disagree. And we use a lot of is it data? Is it not? A lot of NGOs that have rankings. So it's a spreadsheet. It's not like a massive data set. But it's a spreadsheet and a research report on a single issue, maybe on a single or several industries. So we treat it as obviously as useful external data. We're trying to do more work with NGOs who can sort of do more sort of bespoke research for us. I think that's also probably at the moment is probably more interesting than just buying into a new data vendor. Having said that, we are, as I said, we are looking at someone who's we think has a very good, very interesting methodology of assessing externalities of companies. So, but to answer your questions, in summary, I think it's what you need, and you will need different things if you run money in different ways, right? So we're not a high-frequency trading fund where maybe we would then go for sentiment data, which it's less relevant for us. It may be useful for context, but we are more interested in some stuff that's kind of more appealing to long-term investors. So yeah, but choosing is very difficult. And yeah, you have to kind of look at everyone, and it's like interviewing. Do we need this? No. Do we need it? Yes. Is it good? Maybe. And then you kind of go for those stages.
If there are no more questions, then I perhaps will select a few from the app. And John, I wanted to ask you, there is a question about what type of technology should the wealth managers all be adopting for their ESG workflows?
I have really no idea, to be completely honest. I mean, I don't think there is, as a wealth management advisor for a considerable period of time, working in a mid-sized firm at the moment, I'm not aware of any technology solution which would, deal with this issue in terms of advising clients. I mean, there is some good. I think it's Worthstone. People would probably be familiar with Worthstone or with Julia Dreblow's company. They both aggregate information from major providers of these types of investment funds. They then provide reports. So that is, in a sense, a technology solution. But I know that what sits behind that are usually panels of people who are going over the information on the individual investment funds and then arriving at a decision as to whether they think that particular investment fund is impactful or not. So Tribe Capital is another big provider in this area. But they're not really technology solutions. If you unpack what they're doing, they're just looking at the underlying holdings, the strategy or approach that that particular fund uses, and doing fairly traditional fund research in order to arrive at a judgment as to whether that fund is appropriate for a particular type of client. They haven't built a machine to do this yet.
Cara, would you agree that there is no, so to say, fit-all technology at the moment?
I don't think there's a one-size-fits-all technology for wealth management, period. I mean, just about everybody uses so many different platforms to build out their business and to manage their business. The U.S. is much worse than it is here, but yeah, I don't think for ESG there's any one size that works for everybody. And again, the information isn't in there. And you're absolutely right. It's digitally provided research. It's not a tech. It's certainly not tech.
So then the second question goes, what are some of the roadblocks for wide-scale uptake of ESG reporting in WealthTech? And I think we addressed some already. Perhaps there is just a few to add, if anyone from the panel would like to contribute.
Well, I'll jump in. I like to jump in. So, firstly, I think, you know, uptake of ESG and sustainability funds has been huge. I mean, fund flows, certainly in my space, it's been the big story of the last 18 months where, you know, a lot of capital has been moving into this area. So there's certainly uptake. In terms of the challenges, I think technology's got a very important role to play in terms of delivering information in a usable format to advisors so that they can then do a good job of matching funds to their clients' values. I don't think anyone's particularly solved that solution. I don't think you can build something that will bypass assessment of suitability completely, but you can certainly support advisors there. You know, the other roadblocks are really around understanding and for the fund groups to communicate more consistently, I would say, in this particular area. And when I say that, I'm talking about this broader set of strategies that would all sit under a responsible investment banner, so not just ESG. So those are my thoughts. Thank you.
I mean, I think we're out of time, but just quickly, we touched on greenwashing. I mean, I think that's why we've got so many funds out there, you know, painting their strategies green, and they may not be all that green, but they see the flows. So
yeah, that's true. That's true.
Yeah, it's definitely going to remain the topic. Vladimir, anything to add?
Yeah, well, I think, yeah, I agree with John and Cara. It's fear of greenwashing in terms of hurdles and challenges. Fear of greenwashing, lack of sort of understanding the nuance, because obviously you're sort of as an advisor, you're sort of several layers sort of down in terms of understanding the strategy, understanding the nuance of how ESG is implemented. But I think, you know, regulation for all the pain that we had to go through, for example, with SFDR, the regulation in general, and SFDR more specifically, makes that information more transparent and available. And we see our sort of intermediary clients asking us for all the SFDR-related data, so then they can more easily sort the funds on the basis of more sort of granular indicators and metrics, rather than just rely on the name of the fund that says green.
Absolutely. So I see Richard is looking at me and probably saying that we ran out of time, but we probably could talk about ESG, you know, forever, and hopefully can continue over the drinks as well. But thank you very much for your insights and you know, for sharing your experience as well. It was a pleasure. Thank you very much.
Thanks, everyone.